Hello, gentlemen. Thank you for joining this virtual event where we will be discussing emerging market debt. My name's Mark Dunn. I'm the editor of Portfolio Institutional, a magazine that looks at the investment side of pensions, insurers, and foundations. I'm going to be your host for the next hour for what is or should be quite a timely discussion. Projections have pointed to the most of the world's growth emanating from emerging markets in the coming years, and so developed nation investors are struggling in what we know now as a low rate environment, looking for diversifiers and income. Okay, the problem is, of course, since March, the world has been hit by a pandemic, and emerging markets have been hit particularly badly. For instance, India's reported more than 6 million cases, and of course, the upshot of this pandemic is that there have been downgrades. So what I want to do today is just get to the heart of exactly what investors and those they entrust to invest their capital, what they're thinking and how things have changed with those guys. So actually, guys, I think a very good place to start, as always, would be if we could do a few introductions, know exactly who we're talking to. I know a lot of you may have worked with each other and met each other at other events before, but Sammy, could we start with you?
Great, thank you. And thanks everyone for your time today. So I'm Sammy Mwadi. I'm an emerging market debt manager at T. Rowe Price. I've been investing in emerging market debt for 15 years and currently manage both sovereign and corporate strategies.
Okay, thank you, Sammy. And Chetan.
Hi, everyone. Good afternoon. My name's Chetan Ghosh. I am the Chief Investment Officer for the Centrica Pension Scheme arrangements. I've been with Centrica now for 11 years. In terms of the conversation today, worth noting that our pension schemes have been invested in emerging market debt for coming up to 10 years now.
Hey, Chetan. And Christoph.
Yes, thank you. Krzysztof Wasowski. I'm an investment manager for the Royal Mail Pension Plan, which is a around £12 billion pension scheme for the Royal Mail employees. We have been in emerging market debt for quite some time, probably around 10 years as well. But we have a fairly diversified portfolio with EMD being rather low weighted components of with single-digit exposure.
Thanks, Christoph. And last but not least, Alan Pickering.
My name is Alan Pickering. Governance is my full-time job. I'm a professional trustee with a portfolio of about 9 schemes, split very evenly between defined benefit and defined contribution. And like everyone else, I'm trying to find ways of deploying asset classes as appropriate within both defined benefit and defined contribution schemes.
Got you. Okay, thank you very much, guys. Sammy, could we start with you? You told us that you invest in both sovereign and corporate debt in emerging markets. Could you tell us a bit more about what sort of industries, companies, what you're interested in?
Yeah, certainly. So I know 2020 feels different in many ways, but we can still use the same framework that we've been using over 30 years in emerging market debt, and even going back over 200 years to the history of the asset class. Shortly after the Napoleonic Wars, that's when the Latin American republics started forming. And it's a framework anchored in applied history. I'll spend some time on it in a little bit. And really, the analysis on the sovereign debt is first and foremost what you need to look at. While we can be bottom up on the corporate side, there's a diversity of financial services, telecommunications, energy credits that we can look at. When something goes wrong in a country on the sovereign side, then the correlations go to 1. You don't really get that diversification from the corporate bonds. So there's a mixture of bottom up and top down. I would say bottom up analysis is what guides us, but when something goes wrong in a country, as in many cases is happening in 2020, then that top down overlay becomes increasingly important. So I'll spend some time on that as we extend the discussion.
Yes, I'm sure we'll be talking a lot about those issues going forward. Chris, you're telling us you've been in emerging markets for 10 years. Can you tell us a little bit about how your portfolio looks in this particular asset allocation?
Yes, we definitely see EMD as a risky asset class, an asset class which is expected to generate higher than average risks and returns. We've always liked an active management in this asset class, which would allow to dynamically switch between local and hard EMD, between corporates, high yield investment grade. We like currency plays, and also the ability to go long and short, particularly on currency markets. So I think it's definitely an asset class to be not cautiously optimistic, but very cautious about this year. But we still think that there are opportunities, if not in an investment grade, then in high yield space, and even in distressed space, particularly in some sovereigns, which are very interested, which I'm sure we'll discuss later today.
Talking about sovereigns, Chet, you guys are only in sovereigns in the emerging markets. So tell me a little bit about what you're invested in there and why.
Yeah, sure. So we have an 8% allocation to emerging market local currency debt. That is implemented through one manager, again under an active approach. They have the flexibility to go into hard currency and corporate debt as well, but that's more at the margins rather than being the central part of the allocation. Just to give you a flavor, they can do up to 30% kind of off benchmark.
Okay.
The other thing I'd probably say in terms of how we like our assets managed philosophically across all asset classes are managers who think carefully about dynamically altering the level of risk they take depending on the opportunities that are available. So put your foot down on the pedal if actually you're getting well rewarded for risk, but you know, put your foot on the accelerator, on the brake if actually everything's very expensive. And that's particularly salient in emerging market local currency debt, which is a fairly volatile asset class, as Chris has alluded to, where you can get unduly hurt, particularly by the currency fluctuations. So actually, you know, over time, what we found was quite often managers saying, do you know what, we think we're in for some short-term noise, but actually the parameters of our fund don't allow us to really kind of protect capital for you. And so we explicitly went out seeking an approach where actually when they felt they needed to defend capital, they had the levers to do so, and making sure that actually when the opportunity presents itself, they are mentally geared to taking advantage. So that's kind of a brief synopsis of how we access the asset class. So I should make one further point. The reason that we're in local currency versus hard currency is the kind of strategic ambition that we would benefit from the currencies appreciating over the longer term.
Gotcha. Okay. And Alan, the schemes that you work with, is much interest in the emerging markets?
Over the years, the dilemma that I, as a trustee, have had is whether or not to split particular asset classes geographically, and fashion has ebbed and flowed, and over the years, on occasions, schemes have wanted to invest in an asset class without necessarily imposing too many geographical constraints, where at other points in the evolution of different schemes, they have been willing to compartmentalize their asset allocation both by asset type and region. At the moment, most of the defined benefit schemes that I'm involved with are moving ever closer to risk transfer from the employer space to the insurance market. And as they do that, they are looking for income generators with a fair degree of liquidity. And as you mentioned at the outset, Mark, we are in an environment of lower for longer. And obviously, those who are deploying income-seeking asset classes on our behalf are being encouraged to look worldwide, but through a lens which has an ESG flavor to it as well, given that both defined benefit sponsors and defined contribution members are increasingly asking us to look through the ESG lens, and obviously that can be challenging in certain marketplaces.
Gotcha. Okay, Alan, thank you for that. Interesting what Chet said there. I mean, Centrica, they're in local currency debt, of course, is hard currency, local currency. So what about the other guys around the table here? I mean, is anything you're particularly favouring at the moment or thinking of moving into? Sammy?
Sure, I can start. Thanks for that. So our bias, just to maybe for the benefit of a discussion, take the other side of that. Our bias has actually been towards the hard currency side.
Okay.
And I think while currencies should appreciate by nature of what we would read maybe in a textbook about productivity gains and a collapse in inflation differentials and institutional improvement from central bank independence to control the value of the currency, that hasn't actually played out in action. So just maybe a statistic to support that argument. If you take hard currency emerging market debt, in sterling terms, since inception 1993, you would have generated a return of 9.3% per year, which would compound to about 980%. Now, if you take the local currency denominated equities, your return would have been 5.75% per annum. So materially lower. When you compound that, it's about a difference of 630 percentage points cumulative. And the bond side has actually outperformed the stock side, which is very atypical for countries. Hard currency EM bonds have outperformed local currency denominated EM stocks about 2/3 of rolling 3-year periods. So I think what's happened is the currency depreciation has been a relief valve for countries as they've gone through the necessary growing pains of managing external pressures. And looking forward, we don't see that changing, and I can spend some time to try to defend that argument. So our bias has been towards hard currency debt to compound interest. And more specifically or more nuanced, our kind of contrarian view would actually be a core approach to emerging markets should include more of the corporate asset class vis-a-vis the sovereign asset class. I think typically managers will go in and they'll allocate towards sovereign with a satellite of corporates. Yes. We actually think the inverse is warranted, because when you dig into the data, the corporate market, the composition is significantly more defensive and allows you to compound that interest better. And I'll try to extend that as we continue.
Gotcha, of course. Okay. Is anybody has anything else to add on currencies? Because we have Chetan who's gone local and Sammy who's gone hard.
Yes, I think it's important to remember what Sammy said, that the academically speaking, it seems like a clear buy opportunity in local currencies, and I think this is one of the reasons why investors like us are still looking very favorably at soft currency debt, because, well, at some point the multi-year US dollar bull run has to come to an end, and it's the same story with many American assets, stick at equities there, which are just behaving slightly different than we might have expected them a few years ago. So I think it's very important to remember that the currency effect may totally wipe out the very attractive rate returns. And if you look at this year, some of the biggest losers in the local currency debt space were countries with very solid high single-digit returns on rates, which were totally wiped out by double-digit losses on currency. So it's important to be able to hedge the currency, and if not hedge, then at least manage it actively through currency markets and effects.
I think, Mark, in the DC space, if this asset class is to find a home, I think a trustee's starting point will be to hedge the currency. It's very difficult to expect DC members to take too many variables on the chin, as it were, and I think getting the right asset class return is hard enough without trying to second guess the effect of currency. So I think the default position for those trustees of DC schemes will be to start from a high degree of currency hedging.
Okay, thank you guys. Thank you for that. In my opening comments, I talked about how badly the emerging markets have been hit by this pandemic. And of course, emerging markets is quite a broad church. It stretches, from one side of the world to the other. But how exactly have the economies faring? I mean, are they recovering? I mean, Sammy, what are you seeing? What are the high spots here?
Yeah, so let me just take a moment to extend upon my opening discussion. So despite 2020 feeling very different, we can still use the same framework in emerging markets that has navigated us through the last 30 years, that's informed by nearly 200 years of history on sovereign debt. Yeah. There are only, when you look at that 200-year history of emerging sovereign nations issuing debt internationally, there are only 4 ways that a country can go through a period of stress. And these intersect in many ways, but allow me to just state those 4 foundations. The first would be a fiscal risk. The second would be an external risk. The one is the fiscal side being how a country navigates its own finances. Second is how a country navigates its finances with the world. Third would be a period of institutional degradation. And the fourth and final would be contingent liabilities, or the off-balance sheet factors that will then get socialized in a crisis. So certainly COVID, in a way, permeates through all 4 of those in one way or another. But the one that is most acute in 2020 is the fiscal side. We're going to see a very large one-off increase in debt to GDP. And it's probably going to take 3 to 4 years at best for countries to regain where they were from a debt sustainability perspective. Now, the silver lining in all this is just get the bad news out front, and then let's learn how to deal with it.
Yeah.
The good news is there are a lot of multilateral aid programs that have been announced as bridge liquidity, but it ultimately will be, after this necessary fiscal push in 2020, a period of consolidation of finances that's necessary for emerging market countries. We do think, by and large, the mainstream emerging market countries, for the most part, particularly in Asia, entered with enough balance sheet space to absorb this fiscal shock. But we do expect that there will be additional defaults in the frontier markets. There have been 5 in the last 18 months. 3 of those 5 were really not COVID related at all. So we could see potentially another 3, 4, 5 in the 24 months ahead. But I think that would be small enough and largely residing in the frontier space that we think it's something you can stock pick around, if you will, and one that should not sort of contaminate the broader outlook for the asset class.
Gotcha. Okay, Chetan, we just heard there, Sammy, please, we could see 3 to 4 years before things get back to the way they were. Is that what you're seeing?
I mean, I think the statement was around to the time it'll take for debt sustainability to get back to levels that we saw pre-crisis. That's not necessarily a reflection of how corporates or the ability of governments to pay will pan out. I think anecdotally, what we're hearing from our managers is a slight I'm trying to think of the best way to phrase it, but almost in aggregate, these countries may come out of this better in terms of the hits to GDP than developed markets. In terms of, you might still see some positive growth in countries that might even surprise you, like Brazil. So that on a relative basis, is there a strengthening versus developed markets? That'll be an interesting thing to track over these 3-4 year periods, because all of the thing about debt sustainability applies to the developed market countries probably even more acutely to some degree, albeit they don't get punished as much. So that will be an interesting dynamic to track. The other thing that anecdotally that our manager's been telling us is most of these countries are close to fully open in a way that the developed markets are not. You'd be surprised apparently by how open Brazil is, even though the headline number of cases is reported as being sky high. So how that ultimately pans out, effectively no one knows at this stage. And I think it will be 3 to 4 years before we actually see who are the winners and losers, both within emerging markets and whether emerging markets have weathered this relatively better or worse versus developed markets.
Alan, do you think when it comes to emerging markets, the worst has already happened, or do you think the worst is still to come?
I'm not sure that it's sensible to regard all emerging markets as being homogeneous and all investment opportunities within each of those markets being identical. I think that we will need to use managers who are adept at, I hate the phrase, but cherry picking within market segments and within subsets of industries and sovereigns within those market segments. I think, as the other speakers have said, it's hard to know exactly how particular industries or particular territories are going to emerge from the current epidemic.
Gotcha. Okay, Alan. And finally on this point, Christoph, in the areas where you've got exposure, is anything that's particularly worrying you in terms of the economy? I
think more than anything, I wouldn't probably be brave enough to set a date for the full recovery. And as Alan said, it's very varied, the spectrum of the countries. So it's there are surely countries which would emerge stronger, and even timing is different. China's recovery is on a completely different trajectory than, say, Peru's, and I think this is the underlying characteristic of EMD, which is fascinating in a way, that it's such a wide spectrum of countries, and the number of issuers is just huge. So there are opportunities which will emerge from recovery, and Brazil is one of the probably best examples. I'm sure many investors like us expect a lot from Brazil in the coming months. China is an obvious one, and most likely good news for China are decent news for EM overall. So I think there are reasons to be optimistic, but I'm quite worried that globally the pandemic is, we all know as little as everyone else.
Yes, that's a problem, isn't it? Yeah.
Mark, can I?
If I can.
Sorry, can we go Sam?
Yeah, please. You.
Okay, Mark, I was just going to reiterate what my fellow speakers were saying in terms of it is completely idiosyncratic, this universe. You can't talk in generality.
Mm-hmm.
And to me, what that then manifests as being really important is giving your manager as much license as possible to express their idiosyncratic views and choices. Particularly in EMD local, the index and the composition of the index is a bit bizarre. I mean, it almost forces you to have high weightings in countries that you might not like. And so, you know, that in itself presents a problem for managers. You know, they can hold 0 in one country, but it's very hard for them to hold 0 in 2 in that particular index. So actually, you know, having mandates that allow them to access hard currency, corporate, frontier debt, or hold cash even when they need to in times of trouble, I think that's very, very important. So they have the flexibility not to stick rigidly to the benchmark.
Okay, thanks, Chetan. And Sammy, you come in.
Yep. Yeah, thank you. Just to expand upon my colleague's points. So the benchmark in emerging markets, really in all the asset classes, is a horrid starting point. Fixed income benchmarks reward highly leveraged countries and companies with more debt. So if Apple has a higher market cap, Apple gets higher index weight. If Argentina has more debt, then it gets a higher index weight. It's really perverse. Mm-hmm. The best thing I've done in my career is basically ignore the benchmark. I have about an 85% active share or difference against the benchmark. There's about 80 countries I can own. I typically invest in around 25 to 27 of them. And really the country has to earn your client's capital. It's not the other way around. The other thing I wanted to say is we're talking about 2020, and a developed nation goes through a crisis in a very different way than an emerging market nation. When something goes wrong in the United States or in Europe, the government bond yields fall. German bunds fall, US Treasury yields fall. When something goes wrong in South Africa or Turkey, it's the opposite effect. Domestic government bond yields rise. That's really the difference between an emerging nation and a developed nation. So even though emerging countries have lower debt and maybe their fiscal could get in order more quickly than developed markets, the problem is they simply can't afford it when rates are going higher. So they don't have the luxury of working things out over a longer period of time. And I say that a bit bluntly or negatively because we have to accept what the reality is, but that should not stop us from investing. Actually, the best returns occur when things transition from terrible to bad. When a country is in a crisis and transition towards some degree of stability, that's the biggest point of value creation in emerging market debt.
Okay, interesting point. So there was a sell-off in emerging market debt in March, quite a high-profile one. What sort of conversations were you having with your clients at the time, Sammy? Were they particularly bullish? Were they concerned?
Yeah, so in an institutional setting, the good news is we were actually able to literally hold weekly dialogues with clients and actually raise assets through that. So clients were using that as an opportunity to be a liquidity provider. I think that was a rewarding thing for them. So since the end of March, returns are up maybe 25%. I think this is an asset class that has rewarded a contrarian mindset. And what I would underscore, one of my colleagues made this point earlier on the volatility of return. So emerging market debt has a coupon of, say, 6%, roughly, give or take, in the base currency US dollar. You will earn that coupon historically in 3 of 30 years, meaning in 27 of 30 years did not earn the coupon or the 6% carry. You earn some, sometimes 2 standard deviation move away from that. So you can compound over a longer period, but seldom in a single year do you earn the stability. That's just the nature of emerging markets. So what I would encourage is, particularly when you have a view that defaults will remain suppressed, to be a liquidity provider when you see those coupon minus returns, because inevitably these bonds will pull to par, and you for 30 years, you've generally gotten a coupon plus return on the other side of that.
Gotcha.
I think this is a great point, because it's one of those problems with investing in bonds, and I appreciate for many investors, passive investing may sound appealing, but this is exactly what you shouldn't be doing with your bonds if you're a long-term investor. So that's a fantastic point, and I think the pricing this year was obviously unprecedented. Spreads went up to 600-700 basis points at some point, and even now they are still significantly lower by a half, but we're still talking about levels we observed in 2015 when China scared everyone with renminbi devaluations, and that was scary then, and we feel safer and comfortable now. So it's very relative. But I think from a long-term investment perspective, it wouldn't be very prudent to take those decisions when something like March happens again. So I think some patience is required in EMD, definitely.
Good. What about you, Chetan? Are you patient in emerging markets at the moment?
Yeah, very much so. I mean, given that the currency is part of the thesis, you can kind of infer that this is a strategic allocation for us for multiple years. I think in terms of what's happened this year, I've only got my manager's returns. I don't have the index returns for EM local, but up to the end of June, our manager was down 3%. If I compare that to high yield, bank loans, the credit spread component of investment grade, that stacks up well. And I think like the days when EMD was necessarily going to be out of kilter with other markets in the sell-off, I think are potentially no longer with us. People did recognize that some of the balance sheets aren't as scary as they might be for developed markets, that the yield is likely to still come, and it didn't sell off in a really basket case kind of way. Interestingly, on the point of it is an idiosyncratic game.
Yes.
We allow our manager to access frontier markets, and frontier markets have been a positive contributor to performance in that year-to-date number. So they've actually generated positive returns within our portfolio, while wider EM local has sold off.
Gotcha. And Alan, are the schemes that you work with, are they still bullish on emerging markets, or have the sell-offs and downgrades sort of made them be a bit more cautious?
No, I wouldn't say that they were bullish, but I think that trustees are increasingly willing to have a dialogue with their consultants and their asset managers to try and take a contemporary forward-looking view of all asset classes, whether they are asset classes with which they are conversant, or asset classes that might previously have been classed as an alternative asset class. But one of the things that always irritates me is people who articulate the mantra that diversification is a free lunch, which suggests that diversification in itself is something of a silver bullet, and I think that is too simplistic, and one has to be very careful in trying to if one is seeking diversification or seeking to avoid correlation, then one really has to take a cerebral forward-looking view rather than simply saying that almost random diversification equals a four-course free lunch. I don't think it's that easy.
Okay, good. Sammy, this is a crisis, and a crisis, of course, people do say that there's value as opportunity. So where are you seeing the opportunity where the fundamentals are remaining strong at the moment?
Yeah, so I would cast a wider net when looking at emerging markets. I had made maybe somewhat a controversial comment before that an investor should consider a larger allocation to corporates, if not making emerging corporates your core and sovereigns your satellite.
Yeah.
The reason is the key differential there is Asia credit. So Asia credit is a very significant part of the corporate market, but given the quality of those countries, has a de minimis contribution to the sovereign side. So when you're invested in EM sovereigns, you have a higher weighting typically towards frontier markets. And we've seen this, a number of defaults that have happened and that guided could happen going forward on the frontier markets. Whereas Asia credit, so China, Malaysia, Korea, Singapore, Thailand, India, we're much more comfortable with the macroeconomic framework that I started with, those 4 pillars of emerging market sovereign risk. But we can earn additional yield and capital appreciation potential going into the corporate market. Furthermore, to compound interest, you can't lose money, right? So usually the problem with emerging markets is investors in a bad year lose, more than the coupon. When you look at Asia credit in a drawdown, you typically seldom, if ever, do you lose more than the coupon. So your bad year is a 0 return or a plus or minus 1. And that allows you to compound interest over a longer period of time. And I think the stress test with COVID being kind of first in Asia, first out of Asia was a good stress test here. And still Asia credit held in relatively well. It all goes back to the pillars of macroeconomics that provides a stable foundation to then go extract additional yield premium in the corporate market.
Gotcha. And Christoph, where's the opportunity for you if you're seeing an opportunity at all?
Yes, at the risk of sounding very, very adventurous, I would say that the most important opportunities are always in the distressed or sorts of recovery space, and it depends on your risk budget and how adventurous you are. There's always an interesting story, and you don't even have to go to Venezuela, which is, there are still fans of Venezuelan debt, and although it trades at probably 10 cents to dollar, that means there's almost unlimited upside there, and there's very little you could lose. On a serious note, I think there are some interesting opportunities in sovereigns in particular. In this recovery space, there's an ongoing situation in Zambia, although it's very difficult to be super optimistic about it. There's Ukraine, there's Argentina and Ecuador. So a lot of very interesting turnaround stories, hopefully. I think in EM corporate space, there's also quite a few strong names, and in general, I like EM corporates because even in the high yields, if you compare US with emerging markets on average as a universe, the expected recoveries are significantly higher in emerging markets. The expected defaults and realized defaults are significantly lower. And one of the reasons is that since 2015, 2016, a lot of EM corporates had to deleverage and had to make their balance sheet healthier, whereas the US corporates were doing quite the opposite sometimes. So I think it's very simplistic to just look at EMD and think that, oh, it's risky because it's emerging markets, because to some extent, it's risky to invest in UK equities rather than, and we have this home bias here, and EMD is offering a lot of investment grade opportunities and a lot of recovery and opportunistic debt as well. So a lot of different ones.
It's quite interesting when you said you're adventurous. I was actually thinking, is he adventurous enough for Argentina, which is in trouble again? Good. Chetan, are you, of course, with the way things are at the moment, are you tempted maybe to move into corporate debt or move into new sovereigns and take advantage?
Yeah, I mean, our governance model on this is to defer that decision to the manager. So they have ample latitude to pursue corporate and hard currency debt and frontier debt, which they do. Currently, on a relative basis, they do have a preference for corporate and hard currency debt at the expense of local currency. Certainly at a strategic level, it's something we've picked up on as well in terms of having seen high yield and loans retrace significantly post the March lows. Hard currency EM debt hasn't tracked it as much in terms of the rebound. And so we're starting to see a divergence in the kind of forward-looking expected relative returns. So that's something we might look to act upon in the next couple of months.
Fine on this point, Alan. Your schemes, are they perhaps excited to maybe seeing this as an opportunity to expand, or are they, as we said, are they cautious? What's happening with you guys?
I mean, again, if I can just look at the defined contribution space,
yeah,
I think there is a growing recognition that scheme members who are in defined contribution schemes for 20, 30, 40 years, their whole career, rather than just the last 10 years of their current careers following the closure of defined benefit schemes, I think we're going to have to find sensible ways of helping these defined contribution savers access the growth opportunities in emerging markets. And the challenge is going to be how much discretion to give our subcontracted managers in those markets, either to trade between asset classes in determining where best to tap corporate wealth, whether through the equity or through the bond market, and indeed where the bonds are concerned, to determine which territories around the world. And I think there is a real need for us to devote some intellectual capital to find how best to allow defined contribution members to benefit from the asset classes which were traditionally the preserve of the defined benefit scheme. Obviously, in the defined benefit scheme, the employer can provide a buffer, a comfort, whereas in defined contribution space, the profit and loss drops straight down to the member's purse. But I would like to think that an increasing number of asset managers and consultants will be turning their thoughts away from the, if you like, the captive DB market to the embryonic growing DC market.
Okay, we are actually into the last 15 minutes, so there's not long to go. We've still got a few things to get through. It's possible to take a step back from COVID and the pandemic at the moment, talks about more generally, more back to the fundamentals of the emerging markets. China's been mentioned a few times during this discussion. I mean, what impact has them joining the indices had? Sammy, is that something you can comment on?
Yeah, I can start there. Thank you. So I'll make another controversial comment. That controversial comment is that China is already a developed nation. It is no longer a market. The reason I can prove that to you is using the same framework as before. When COVID hit China, Chinese government bond yields went down. When COVID hit Italy, ATP yields went up. So you tell me which one is an emerging nation and which one is a developed nation. And clearly, I know all the caveats around that. We can go into it. I'm intentionally controversial. China needs plenty of progress to make. But from a macroeconomic foundation, they control their own monetary independence. That affords you many degrees of freedom in managing balance payment shocks, fiscal shocks, or global healthcare shocks. Now, China has a reduced current account surplus. They used to be a twin surplus country, both in the current account and the capital account. That current account has gone down and probably will continue to go down given the trade tensions. And rather than kind of leak out FX reserves, one thing they're looking to do is bring capital into the country very gradually. That, in combination with One Belt, One Road, is part of the long-term plan. When I say long-term, I mean 20 years plus, to internationalize the RMB and make it a reserve currency. Is to be determined whether or not that happens. But a reserve currency is really the great exorbitant privilege of nations. You know, looking back at the UK's history and the US's history, you can export paper and import everything else. China wants that exorbitant privilege too. Mm-hmm. And I think there'll be a well-managed transition because they have their eyes on the long game.
From my own personal point of view, I don't think you've made a controversial comment there about China being a developed market. That's something I've sort of seen for quite some time. Does anybody else here have any other comments to make about China joining industries and China in general? Chet, I think you want to come in.
Yeah, I mean, again, you know, it's all down to what we delegate to our fund manager. Mm-hmm. The fact that they run an unconstrained approach means that when China hits the kind of bond indices, there isn't going to be an overnight step change for us. But my understanding is, you know, it will have material impact on those managers that are much more closely aligned to benchmarks, and that needs some, you know, that needs some thinking about.
Gotcha. Okay. Sorry, Alan, did you want to come in there?
I was just going to pick up on Sammy's suggestion that he was being outrageous. I think that in the long term, China is part of the solution rather than the cause of the problem. The challenge is always to manage the transition in a way that doesn't do any collateral damage either to China internally or to world markets externally. But I certainly think that China will be part of the solution and not part of the problem.
Gotcha. Okay. Another issue with emerging markets, and doesn't seem to go away, is the issue of transparency, called transparency. Has that been improving? It's something. What are you seeing there in terms of this? Have there been leaps and bounds here?
So on the sovereign side, I would say over 20 years, there has been broad institutional improvement. Think about the Central Bank of Indonesia today is considered independent and credible. If you were looking at Indonesia in the 1990s, that would be a wild thought to see where we are now. However, there are still pockets, particularly in those countries that are borrowing bilaterally from maybe Chinese development banks or other Middle East sovereign providers. You've had reduced transparency in some of the frontier markets, and I would put Turkey into that bucket as well. So broadly improving, although some degradation on the margin in the last 5 years. On the corporate side, I would say the improvement in corporate transparency has been unequivocally positive. As these capital structures for EM corporates have globalized, they've gone from being banked within their country to being banked abroad. That puts a higher standard on transparency. So unequivocally, you know, still plenty of room to progress, but the corporate transparency in emerging markets, I've been doing this for 15 years, has probably never been better.
Good. And Christoph, are you seeing positive movements here in terms of transparency?
Yes, I think. I mean, definitely as an institutional investor who doesn't invest directly through. We invest same as Chetan through investment managers. We only see the part of the picture. However, what I'm hearing is that yes, definitely that echoes what Sammy said about significant improvement over the years in the corporate space, and I think this is a great role of EMD investment in general, because the more transparent they become, the more likely we are to invest with them, and that makes them more likely to become even more transparent. Obviously, there are exceptions, and there are challenges, and it's emerging markets for for a reason, and you have to tread carefully there. And I think it's not just transparency; it's the overall engagement issue, which also well, we weren't supposed to discuss ESG in particular, but I think in terms of governance, it's an important issue of transparency, and I think what I'm hearing from our investment managers is it's still challenging. You can still make a difference, but it's the usual challenge with debt investors versus equity investors. It's more difficult, but then also it's more direct. The engagement the large manager may have with the access to the governor of the central bank, to the finance minister. This is something which is possible in emerging markets, and same with the CEOs of large corporates.
Gotcha. Alan, when you introduced yourself at the start, almost 50 minutes ago now, you said that your job was governance. So are you happy with the sort of governance in terms of the people you guys are investing through, in terms of getting information out of corporates and governments?
I think that we're moving from a world of advertising department rhetoric to investment manager engine room when it comes to transparency and ESG in its positive sense. And again, I do see that as a two-way road to salvation, in that the better governed our countries and corporates, the more accessible are those governments and corporates to institutional investors such as us. And if we as institutional investors can provide them with seed corn at appropriate times, then that should be a win-win. And therefore I am very much a multinational internationalist in trying to make sure that we do continually seek to improve standards of governance, transparency and interdependence.
Finally, this question to you, Chair. I mean, you don't invest in corporate, you invest in governments, and you invest from intermediaries, of course. But does the level of standard of governments, does that worry you?
No, I mean, I think my view comes at it from maybe a slightly different place, in that, I mean, we've been equity investors for a long time, up until last year. And overall, I'd probably say, this story that EM transparency is a whole lot worse than developed markets, that doesn't really wash for me. I think the differentials are marginalized, and I'm not sure to whose advantage it is to keep propagating that story, but I just simply don't think that you have this massive differential anymore. We get accounting incompetencies in developed markets. We get frauds in developed markets. The same happens in emerging markets. I'm not sure there's that much difference in the frequency of these events. It's just it really does become now more idiosyncratic, and hopefully our fiduciaries who invest the capital for us will stay away from those companies where they're not getting the required transparency. It then reflects in the cost of capital, and corporates have to react accordingly. So I think it's an issue of 20 to 30 years ago. Over the last 10 years, I think it's really at the margins.
Okay. Thanks, Chetan. We're almost up to the hour mark. Someone's come in.
Oh, just very briefly, if I can add an anecdote. Before I was a portfolio manager, I was an analyst covering emerging market banks. I was asked to look at European banks during the crisis, because apparently that was more of an emerging market skill set. And the most trouble I ever had, the most trouble I ever had as an analyst looking at accounting was with Irish banks.
Okay.
I'll leave that there.
There you go. Good show. As I say, we're almost up to the hour mark now, and there's a few things we didn't get to, but I think we'll just one final question for you all, and you might be summarising a lot of what you've already said in the past hour or so. Just your outlook for emerging market debt. I mean, we're in the final third of the final quarter of 2020, and it's been one hell of a year. So we're going into 2021. Sammy, could we start with you? Just give us your thoughts on going forward.
Sure. So I'm optimistic. The asset class has earned optimism with over 9% returns in sterling for a quarter century. Now, you don't get the same kicker from government bond yields declining. So that wedge from treasuries or gilts is evaporated. But the margin over the risk-free rate is largely unchanged. And so therefore, I remain optimistic with not only a one-year view, but with the long-term prospect on the asset class.
Thank you, Sammy. And Christoph?
I wouldn't say I am optimistic because I'm cautious, but I'm actually cautious about pretty much every risky asset class right now. So it has nothing to do with EMD in particular. However, as institutional investors, as fiduciaries, we have a duty, and we can't sit on negatively yielding cash and wait for the storm to pass. We have to find opportunities. We definitely aren't looking at EMD in any different way than we were a few months ago. It's still a risky asset class. There's still opportunities. If we were to divest, that would be purely on sorts of risk return grounds and the opportunities which could be more attractive elsewhere. But I definitely wouldn't recommend being afraid of EMD just because pandemic might hit them harder than developed markets.
Gotcha, of course. And Chetan, your final word here, the outlook.
Yeah, I'm not going to go over the ground we've talked about over the hour. I think the only other point I would just add in is the actions of central banks in developed markets in terms of asset purchases and QE are going to force investors to carry on the hunt for yield. And emerging market debt provides some of the highest yields on offer, particularly if you think about it versus the credit rating or risk involved. And that could create quite a heavy technical tailwind for the asset class.
And the last comment of this particular debate goes to Alan. What are you expecting going forward?
Yeah, most of my defined benefit schemes are looking for yield as they move towards low dependency on the sponsor and ultimate risk transfer to the insurance market, and yield has an important role to play. I just want to make sure that trustees and their consultants don't turn a historic prejudice into a permanent principle, and I think that our consultants have a duty to make sure that we look even-handedly at all forms of debt, and in so doing determine whether emerging market debt has a role to play on a scheme-specific basis as each of those schemes move to their destination, which in DB land is risk transfer to the insurance market.
Okay, thank you, Alan, and thank you all. Thank you, Sammy, Chetan, Chris, Alan. That's great. That was an hour. That flew by. There's a few things we didn't get to, but I'm pretty sure this is a topic we will be revisiting in 2021 to see exactly what has been happening and where we go from there. I say I'd like to thank you all. I'd especially like to thank T. Rowe Price for sponsoring this virtual roundtable. And I say goodbye, and I wish you stay safe. Thanks, guys.